Hi, I'm Ollie, and in this Investing for Beginners video, I'm going to explain why your cash is devaluing, and I'm going to show you how to start investing in the stock market. Like everyone, when I started investing, I did not want to lose my hard-earned money. So I started investing with a small amount. So I want to show you how you can start investing with little money and hopefully grow your portfolio over time. This is a beginner-friendly video, and so I will break everything down because the finance world is full of jargon. From the outset, I want to be clear, investing is a long game and you are not likely to get rich overnight. You may see people flaunting their cash all over social media, but it's unlikely this was from investing, unless they are investing in risky assets. You may have heard of the terms day trading and investing, which are two very different things. Investing is buying into something for the long term with the hope that it appreciates in value and is based on the prospects of the company or the asset that you bought. Day trading, on the other hand, is making quick trades in and out of an asset by looking at price charts with little to no interest in the prospects of the underlying company or asset you are trading. And while with day trading you can reap the benefits of your trades straight away, unfortunately, if you think you are going to do this straight away, I must warn you, it takes years of education to become good at this, and 97% of day traders lose money. So this video is not about day trading, but instead about investing for the long term. So this video is the ultimate guide to stock investing for beginners 2023. I'm going to break this video into parts, all of which are timestamped below, so feel free to jump forward or backwards. In part 1, I'll answer the question, why should you start investing? And I'll tell you the basics behind investing and how you can potentially make or lose money with the stock market. In part 2, I'll explain how to invest and what are some things you can invest in and where you can buy them. And in part 3, I'll go over some common questions and fears. If you have any additional questions at any point, then feel free to drop them down below and I'll try my best to answer each and every one of them. Now, before we get stuck in, I must be clear, I am not a financial advisor and nothing in this video is intended to be financial advice. And if you want financial advice, you should seek a licensed professional. At the end of the day, I am just a guy on YouTube, so you should always do your own research, and past performance is not indicative of any future results. So now that's out of the way, let's get stuck in. So part 1, why should you start investing? The idea is to hopefully get your money to make you more money. If you have cash or keep money in a bank, it's losing its buying power over time due to inflation. For example, if you have £100 now and it can buy your weekly food shop, well, say inflation is at 10%, then next year your equivalent food shop would cost you £110. So unless you're earning interest in your bank that is higher than the current inflation rate, then your cash is losing its purchasing power over time. Now, I'm not saying don't keep your money in a bank, because you should always have access to a readily available rainy day fund, but if you have more than 3 to 6 months worth of cash that you need to live on just sitting in a bank, then there may be some better options. So the idea with investing is that hopefully you can beat inflation and hopefully even make you money on top of this. This brings us on to the question of, how does investing grow your money? There are 2 ways that stocks can make you more money. The first is through something called capital gains, which is when you buy something and its value hopefully goes up over time. For example, when you buy a house, you'd hope it goes up in value by the time you come to sell it. So say you buy a house for 300k and 10 years later, the value has gone up and you sell it for 400k, then the capital gains would be equivalent to the profit, so 100k. This is the same for stocks. If you buy Apple shares at $150 each, and then Apple's stock price goes up to $200 a share, for each share you sell, you would have made $50 in profit, or capital gains of $50 per share. The second way you can make money from stocks is through dividends. This is when some companies pay out some of their profit as a way of saying thank you to their investors. If a company pays dividends, it will likely pay them out every quarter or half a year and is generally more established, older companies, for example, companies like McDonald's, but you do get the odd tech company offering dividends like Apple. Some people actively invest in stocks that pay dividends as a way to receive recurring payments, but it's worth noting that even if a company has paid out a dividend in the past, they have no commitment to keep paying them, and they could reduce their dividend payments or stop them altogether if they wanted to. This is why I personally view dividends as a bit of an added bonus, and I would never personally pick a stock just because they offer a dividend. So this brings us nicely onto part 2. So firstly, I'll answer, how do you start investing? When you're investing, if you buy a share of a company, then you are buying a tiny percentage ownership in that company you're investing in. So if we go back to my Apple example, because it's a publicly traded company, the public can trade Apple stock, and to purchase shares of Apple, you need to go through a middleman who facilitates this deal, and they are called a broker or stockbroker. Each company's stock will have a different price depending on how much people are willing to pay for it at that point in time and how valuable people think it may be in the future. Each publicly traded company will be listed on at least one stock market around the world. Most countries have one major stock market, and in the case of the US, they have multiple. In the UK, you've probably heard of the London Stock Exchange, which holds companies like BP and Shell, HSBC, Unilever, to name a few. In the US, one example is the New York Stock Exchange, which has stocks such as JP Morgan and Visa, to name a couple. All of these stocks can be bought through a broker. So this brings us on to, what should you invest in? Firstly, I'm not a financial advisor, but there are so many things you can invest in. Stocks, ETFs, mutual funds, bonds, real estate, options, forex, futures, crypto, NFTs, art, watches, and unfortunately I do not have time to go into all of these today, and not all of them are available on a stockbroker anyway. But considering this video is all about stock investing for beginners and how to start investing in the stock market, I'll be touching on 2 or 3 of the most common ones. So the first thing you could invest in is individual stocks, which is what I thought you had to do when starting investing. And it's actually not the case, but I'll come on to this more in a bit. Firstly, if you're going to pick stocks just because you know and like a company, it doesn't mean they are going to perform well. Picking individual stocks that will perform well takes a lot of time, and if you aren't doing the research and keeping up to date on the news of these companies, then technically you are kind of just gambling. Alternatively, you can invest in something called an index fund, which technically 90% of professional fund managers can't even beat when picking individual stocks. And even Warren Buffett, who is one of the richest people in the world and who got there from investing, said, "If you are a beginner, then you should not try and pick stocks unless you are a financial professional." Maybe I do that again. All right, we'll try once again. "The average person will not know enough to know which stocks to buy. They won't know enough to know when to buy them, but they don't have to because they can buy all of America through an index fund." That is a really bad American old man impersonation. My eyes are watering after that. Note to self, don't try to impersonate Warren Buffett. So what is an index fund? A fund is a group of assets, in this case a group of stocks and shares. And the index part of it means it tracks a stock market index. You will have probably heard of some of these indexes on the news. For example, the FTSE 100, Dow Jones Industrial Average, NASDAQ, or the S&P 500 are some stock market indices. So for example, the FTSE 100 is an index and is 100 of the largest companies on the London Stock Exchange. And the S&P 500 is another index and is 500 of the largest companies on US exchanges. And you can see here, these are the companies in the S&P 500 right now. Most of the value in the US stock market is in these 500 companies. And the point of a stock market index is that it can be given a single number that can be used to gauge the performance of a stock market as a whole, which can then be plotted on a chart over time. If the value of these 500 companies, or the majority of them, increase in value, then that means the US stock market is doing well and the S&P 500 will go up. Alternatively, in times of fear or a recession, people may be willing to pay less for the underlying stocks, perhaps due to the companies making less money, and so in times like this, the S&P 500 may go down, and you can see these fluctuations on the charts. And these can be viewed in loads of places online, like on Google or your stockbroker. So let's say you invest in an S&P 500 index fund. Then you will buy one share, and then your money will be then split and invested in all 500 of these companies with one purchase. So this is great for what's called diversification. And this is the equivalent of not putting all your eggs in one basket. For example, if you invest in one company, and so the equivalent of putting all your money or eggs in one basket, and you drop that basket, then you would lose all your money or your eggs, which would not be good. But if you have lots of baskets and spread your money across each of them, then say you dropped one of the baskets, it would not be as bad because you have all the other baskets still that are hopefully still doing okay. So index funds are great because they diversify your money across lots of companies and sectors, and you're not making a bet on just one company, but instead on the economy as a whole. So you're basically betting that a specific country or group of countries' economies will continue to grow. Now, the S&P 500 index is actually weighted by market cap, and a market cap is the value of the company. So say you bought $1,000 of an S&P 500 index fund, because Apple is weighted at 6.8%, you would now own $68 of Apple. Then the next biggest is Microsoft, weighted at 5.7%. So you would now own $57 of Microsoft, and so on and so on. So index funds are great for a hands-off approach, as you don't need to spend hours every week keeping up with the news on the companies you've invested in. So why would someone not just invest in index funds? Well, it's a tie-off between risk and reward. With more risk comes more rewards. So, for example, an S&P 500 index fund may on average make 7 to 8% per year over a long period of time. But if you invest in individual stocks and get lucky, you may make way more than this. But on the flip side of this, if you are unlucky, you may lose money. And like I said before, the chance of you beating the S&P 500, or beating the market as they call it, is slim, considering 90% of professional fund managers can't even do it. And even if they do on 1 or 2 years, the chance they repeatedly do this year over year is even slimmer. So before we go any further, I may as well talk about ETFs. These are funds traded on a stock exchange, and you can get index tracking ETFs like the index funds, or you can even also get ETFs that are more broad and may invest in a sector such as genomics or financial companies rather than a stock market as a whole. ETFs are traded on a stock exchange all day long, and the price changes all the time, whereas index funds can only be bought and sold for the price at the end of the day. So now you've decided that you want to invest in an ETF, index fund, or pick stocks. How do you go about doing this? So this is where you need to use a stockbroker, and this is going to vary by where you live. But there are some big global ones. It's worth doing a bit of research here and finding one that is right for you. Ideally, you want one that's regulated and has some kind of insurance to protect your funds if, say, something goes wrong with them. You'll also want to check the fees, because these can vary wildly, where you may pay up to £11 a trade on an old school broker like Hargreaves Lansdown, but you may get commission-free trading at another broker. You may even want one that has a demo account so you can learn what you're doing and play around before risking any real money. Also, depending on where you live, some countries have tax-efficient ways to invest. So for example, in the UK there are ISAs, and in the USA they have Roth IRAs. So if you're in the UK, you may be better off using a platform that offers an ISA, which is a tax-free wrapper that allows individuals to invest up to £20,000 a year, where all the gains you make are yours to keep. But again, always do your research, because this could change at any point in the future. If you want a tax-efficient way to invest in index funds in the UK or USA, then you may want to check out Vanguard. But Vanguard only offers index funds, so if you want to dabble with some shares at a later date, you may be better off with a different platform. I personally use two main brokers. eToro is one of them and Interactive Brokers is the other. eToro is a very easy to use platform with a range of assets such as stocks, cryptos, forex, commodities, ETFs, including index tracking ETFs, and this is what I started using when I first started investing. They have some cool features which allow you to copy other investors, which is what I did when I first started investing, as I didn't know index funds even existed. So that is another hands-off approach, and I still personally copy a few people on that platform today. And literally as of this week, eToro has announced they have partnered up with Money Farm to allow their customers to open a stocks and shares ISA. The second broker I mainly use is Interactive Brokers, which is more advanced, and if you're starting out, I probably wouldn't recommend it as it's much less beginner friendly. But it does have access to more stock exchanges and assets than any of the other brokers I could find online. But it does also come with more fees. I personally purchase index tracking ETFs on Interactive Brokers, and I'm investing in a NASDAQ ETF and an S&P 500 one. If you want to sign up for any of these brokers, then I have links to these below. eToro and Interactive Brokers have affiliate links, and if you sign up and use them, then I will get a kickback, which massively helps support this channel and doesn't cost you anything extra, so I'll be forever grateful if you use them. But like I said earlier, there are tie-offs with all brokers, so you need to do your research here. But if you do want an in-depth guide for signing up to eToro and how to make your first investment, then I recommend checking out this video up here, and I'll also put the link to it in the description below. Another thing worth noting here is that often you get two variations of index funds depending on how dividends are paid. And these are accumulating and distributing funds. Accumulating, often seen as AC or ACC, reinvests any dividends paid out by the company back into the funds for you automatically. Whereas distributing, often abbreviated to DIS, will pay these out as cash. Some platforms will notify you've received dividends, others won't. So it's worth checking with your broker here. So moving on to the last section, which is common questions and fears. So the first question is, will I lose my money? Well, possibly if the value of your investment goes down and you cash out. Unfortunately, investments do go up as well as down. For example, say you invested $1,000 right before the pandemic into the S&P 500, then within a couple of weeks, your portfolio would have been down 35%. So had you cashed out here and sold your investment, then your $1,000 would now be worth $650 because you realized the loss, aka sold your losing position. But had you instead waited until August, then your investment would now be in profit again. But with investing, there is no guarantees. Who's to say if you had not sold when you were down 35%, that it may have gone down further again? But while past performance is not indicative of future results, if you look at this chart here of the S&P 500, it has generally gone up all the way since the beginning of time because you're kind of investing in the US economy doing well. That's not to say there aren't extended periods where you may not make money. For example, the dot-com bubble from the year 2000 up to December of 2006, you wouldn't have made any money. So you have to be prepared. There may be extended periods if there is a catastrophic event. But again, if you had held and weathered the storms, you would have come out on top at the other side. In reality, the longer you become an investor, you will learn to get excited over dips in the market as they pose an opportunity to buy more at a cheaper price. But the longer you leave your money in something, the more it will compound over time. But going back to the original question, if you invest in individual stocks or risky assets like crypto, there is a higher chance you may lose money. So if you are going down this route, make sure to do your own research. For example, if you invest in an S&P 500 index fund, then the chance of all the companies going bust, it's not impossible, but it's basically like 0%. It would probably take something like a nuclear disaster or some ridiculous disaster to wipe out the value of 500 companies. And if this happens, I'm pretty sure you'd have other things to worry about in the world. Remember, each of these companies in the S&P 500 are trying to grow, so you would expect the S&P 500 to hopefully go up over time. So the next question, how much money do you need to start investing? Well, this depends on which broker you use, but With eToro, the minimum first deposit is $10 in the US and the UK is $50, and it goes up from here. The minimum deposit on Vanguard in the UK is either £100 or £500, depending on how you set this up. Interactive Brokers has no minimum deposit, but overall, this varies massively by your country and broker, so you will need to check this. So the next question, can you make much money if you don't have much money to invest? Well, there are no guarantees in the stock market, so unfortunately there is no way to say for definite, but if we base this on history, say you put £100 a month in, and then at the end of the first year at 8%, you would have gained £96 in interest. In 10 years, you would have contributed £12,000 and made £6,295 in interest, bringing it to a total of £18,295. In 20 years, you would have contributed £24,000 and earned £34,902 in interest, with a final balance of £58,902. And in 30 years, you'd have contributed £36,000 with £113,036 in interest, and so bringing it to a total of £149,036. So this is why Einstein calls compound interest the eighth wonder of the world. And it really highlights the power of compounding, where your interest makes you more interest, and the longer you are in the market, the more money you can potentially make. This also highlights how a small investment today can go a long way in the future. And even though this example used £100, if for example at some point you were able to contribute more money, it would grow even quicker. This is why you may have heard the saying, it's more about time in the market than timing the market. So when should you invest? Trying to time the market is impossible, and most people that try to do this actually end up not buying at the bottom, as they think it's going to carry on going down and instead miss it as it goes back up. No one knows when the market will tank next or bottom out. Otherwise, everyone would be a millionaire. So don't listen to someone on YouTube or Twitter claiming they know. There has been so many studies on this, but the consensus is just to invest consistently over time. So should you try and sell at the top and buy back in at the bottom? Well, you're verging on trading if you're doing that, but if for example you tried to time the market and you had missed the 10 best days every decade since 1930, your return from the S&P 500 would be only 28%. That's like 28% over 92 to 93 years, which is ridiculous. But if instead you had stayed invested, then your returns would be 17,715%. So this highlights the power of staying in the market. How long should you invest for? Again, this is up to you, and while past performance is not indicative of future results, if history is anything to go by, then the longer you are invested, the more chance you have for it to grow. But again, this depends on you personally. Someone closer to retirement is going to want to do something completely different to a 20-year-old. If I could turn back time, I personally wish I would have started earlier had I known what I know now. So if there's one thing to take away from this video, it would be that I recommend just getting started, even if it's with a demo account. But as I mentioned earlier, let us know below if you have any other questions, and I will try my best to answer all of them. And if you got any value from this video, then please don't forget to smash the like button. And if you want to know how you can get started with investing from opening an account all the way to buying your first shares, then I recommend checking out this video next. It's been Ollie from Get Geek Finance. Thanks for watching, and I'll catch you in the next one.